Good day, Professor Jeremy. I'm CFMayJuneGroupCheahJoonTing, and my team member have Lauren Tiong, Tiong Chiu Mi, An Sok Fong, and Chia Ji Jian. We're looking forward to share our work with you. And I'm going to present Introduction of Corporate Finance. Corporate finance is a branch of finance that deal with how companies manage their money, make financial decisions, and create value for their shareholder. This is focused on their financial activity of business, including funding, investment, and capital structuring. The main goal of corporate finance is maximize shareholder values while managing financial risk. This involves decision how to raise capital through debt, equity, or a mix of both. Where to invest, such as in new projects, products, or markets, and how to manage day-to-day finance like cash flow and working capital.
Lawrence Tiong. Let's look at the performance analysis of company A versus company B based on the financial ratio. A. Liquidity ratio. 1. Current ratio is a ratio of current assets over current liabilities. It is the ability to meet short-term liabilities. For company A, stable ratio over the years, indicating solid improving short-term liabilities. For company B, it's excessively high at 32, implying underutilized current assets. 2. Quick ratio, current assets minus inventory over current liabilities. It is the ability to meet short-term obligation without selling inventories. For company A, it's improving, but still less than 1. Some reliance on inventory. For company B, the ratio is very high, showing over liquid asset or low short-term liabilities. Profitability ratio. 1. Gross profit ratio is a gross profit over revenue. It shows efficiency in production costs. For company A, slightly decline, but still manageable. For company B, major drop in year 3, higher cost of goods sold, implying weaker cost control. 2. Operating profit ratio is the earning before interest and tax over revenue. It simply means operational efficiency before interest and taxes. For company A, margin falls to 9.4%, still profitable. For company B, turn negative in year 3, recording operational losses. 3. Net profit ratio is a net profit over revenue. It shows the final profitability after all expenses. For company A, slightly declined to 6.6%, still performing well. For company B, turned negative in year 3, highlighting a decline in overall performance. 1. Debt equity ratio, total liability over total equities. It indicates leverage and financial risk. It is also a key indicator of financial health and stability. Higher DE ratio means rely heavily on debts. Company A, moderate leverage, 1.1 to 1.6. Company B, low leverage, underutilized on debt, also implying a stable financial position. 2. Interest cover ratio, earning before interest and tax over interest expenses. It is the ability to meet interest payment obligations. Higher ratio means strong ability to cover interest. Very healthy at 4.046. For company B, huge drop into minus 3.9 negative, reflecting financial distress. D. Turnover ratio. 1. Fixed asset turnover ratio is the revenue over total fixed assets. It evaluates using of long-term assets. Higher ratio means effectively use its fixed assets to generate revenue. For company B, have higher ratio, therefore is more efficient than company A. 2. Inventory turnover ratio is cost of goods sold over inventories. It measures inventory efficiency. Company A shows consistency, 5 to 5.8. Company B dropped to below 3, which means slower inventory movement. 3. Account receivable turnover ratio is the revenue over total account received. It shows how effectively a company can convert its receivable into cash. Company A, 41 days, faster collecting practice. Company B, slow, 84%, inefficient collecting practice. E. Earning ratio. 1. Earning per share, profit attributed to ordinary shareholders over number of share issues. It measures company profitability. Higher earning per share means poor profitable. Company A has stable earning per share. For company B, drop to negative, implying poor shareholder returns. 2. Profit earning ratio, PE ratio, is the number of shares over earning per share. PE ratio is used for valuing companies. Company A have healthy valuation despite it. Company B is negative profit earning ratio in year 3, indicating investor loss of confidence. In terms of performance, Company A shows stronger and more consistent financial health than Company B, particularly in profitability and earnings. For Company B, although higher efficiency and liquidity, but poor profitability and recent loss might pose significant risks. Therefore, Company A would be the preferred investment, especially with its stable earning per share and improving cash flow. Thank you. I will pass to the next speaker, Ms. Ding Chuan-Mi.
Hi, good day to Professor Jerome and my beloved team members. I'm Ding Chuan-Mi. Today, I will talk about the performance of Company A, Press Mentor Berhad, over the last 3 years, and then compare it with Company B, Chumbi Mentor Industry Berhad. I will focus on key areas like revenue, dividends, and cash flow. Let's start with Company A, Press Mentor. In revenue area, Company A stay above Ringgit Malaysia 8.8 million every year, which show their sales are strong and stable. There was a small drop from year 2 to year 3, but overall sales remain high for the Company A. For dividend per share, dividend decreased gradually every year. This may sound negative, but it might mean the company is keeping more profit to invest back into the business for future growth. For operating cash flow, this is one of the strongest points. It went from around Ringgit Malaysia 393,000 in year 1 to overall Ringgit Malaysia 1.4 million in year 3. There's a big increase, showing the company is getting better and better at turning business activity into cash. For investment area, let us see the investment cash flow for the Company A. This was negative all 3 years, which is gradually a good sign. It means the company was spending money to invest, maybe in buying equipment, or expanding operations. For financing cash flow, also negative every year, meaning the company was likely repaying loans or giving out dividends. This shows good financing control, not too dependent on borrowing. So overall, Press Mentor shows stable revenue, strong cash generation, and is clearly investing for the future. Now, I would like to compare between Company A and Company B. Press Mentor is Company A and Chumbi Industry is Company B. In revenue area, Press Mentor's revenue stay high and stable, while Chumbi revenue drop every year from Ringgit Malaysia 456,000 to Ringgit Malaysia 443,000. This shows Press Mentor is more consistent in sales. Let's look at dividend per share. Both companies has strong dividend over time, but Company B, Chumbi's drop was sharper from 9 cents to 5 cents, which may reflect weaker profits. Press Mentor drop was slower and more stable. For operating cash flow, Press Mentor has a strong and steady increase, while Chumbi's one was inconsistent and only improved in the 3rd year. This suggests Press Mentor is better at managing its operations. Investing cash flow, both companies have negative investing cash flow, but Press Mentor was much higher, meaning it's more active in growing the business. To be low investment may mean they are not expanding as much. For financing cash flow, Press Mentor shows steady repayment and control, while Chumbi financing flows went up and down, showing a less stable approach. In summary, Press Mentor is stronger in overall. It's more stable, growing faster, and managing its money better. Chumbi looks more cautious, with slower growth and a sign of challenges in maintaining the company performance. To conclude, Press Mender Company A performed well over the 3 years with strong cash flow and investment. When compared to Chumbi Company B, Press Mender is clearly more stable, efficient, and growth focused. Thank you.
Good days, everyone. I am Ang Su Fong. Based on the 5 key financial ratios, I am presenting what are the possible reasons for the ratio performance and movement Company A and Company B. Let's begin with the Company A. Company A saw improved liquidity over the past 3 years. This means Company A has better working capital management, timely debt repayments, and increase in cash and receivable. However, the Company A profitability has declined. This may be due to several factors. First, the company may facing higher operating costs, such as increased expenses for raw material and overhead. Second, company may pricing the product more competitively to stand ahead in the market. Now, let's move to company financial, leverage, efficiency, and market performance. Based on the performance ratio, the debt ratio saw the company reduced the debt in year 2, but took the new borrowing in year 3. This mostly funding for the new assets. The new fundings lead to higher interest expenses. However, the interest coverage ratio remains above 4 times, indicating that the company has no difficulty in paying interest expenses. For the inventory turnover, which remains strong over 5 times, showing healthy stock movement, stable production, and sales cycle. The company collect payment from customer faster than before, suggesting stronger credit control, good customer profile, and favorable credit terms. Lastly, for market indicators, the company earnings per share is falling. This might suggest undervaluation in the market or decline in investor confidence. That's for the Company A. Let's move to Company B. Company B have extremely high liquidity. This suggests that the company hold more current assets than operation usually needs. This might be keeping too much of cash or stock, which could indicate weak sales and underutilized resources. Most importantly, the company reporting net loss in year 3. This could be caused by the low sales volume and high operating costs. Company may not generating enough revenue to cover their expenses. Now, let's go to company financial, leverage, efficiency, and returns. The company has almost no debt. This sounds good, but it also means the company are not using borrowing to grow the business. The interest coverage ratio so negative, which means company sales unable to pay off the debt interest. The company also weak control over customer payment. Company took loans to collect money from customer, which affect the cash flow. The earnings per share so negative. This mostly due to company making losses. This cost less attractive to investor. That's for the Company B. Under the recommendation, Company A has improved liquidity and strong receivable collection. However, its profitability and earnings per share is declined. So, Company A needs to focus on cost control and margin recovery. Company B, on the other hand, is experiencing financial stress. The company must implement urgent operational restructuring, optimize asset use, and implement stable business development. That's all from me. Let's move to question B. Thank you.
Hello everyone, I'm CFMayJuneGroupCheahJoonTing2025. In this section B, I will explain how financial information like environment data, community effect, and sustainability report can impact investment decision and company reputation. I will use two Malaysia metal company as example, Company A and Company B. I will talking about how can environment data influence investment decision in Company A and Company B. Environment data can help investor manage risk and long-term stability. Environment data also can affect credit rating, loan interest rate, stock price stability. Next, I will compare Company A and Company B. Company A have a detailed ESG report which enhance this credibility and attract long-term investor. On the other hand, Company B is still in transition period, which means high short-term risk but great long-term gain potential. Next, I will talking about why should stakeholder care about community engagement effect by those company, because it is direct affect reputation. Affect active participation can build trust and gain government support, talent and customer. Young people and investors who pay attention to ESG prefer responsible company. Operations stability. Good community relation can prevent protests and riot. Sustainability, especially important to industry area close to residential area. In the shortly, if without strong community support, even profitable company may force closure or delay. Next, I will talking about how can financial reporting impact the reputation of precious metal and chubby metal. Precious metal comprised with international standards such as GRI and SASB, validated by KPMG. MSCI ESG rating increased from A to AA. Introduced green products such as GEM aluminum. Over 1,900 people benefit from CSR program. Chubby metal, strong anti-corruption and whistleblowing policy, focus on waste, energy and carbon emission control. 93% customer satisfaction. Structure standable. Development governance. Compressed with GRI, SDG and PUSA ESG standard. Thank you for listening.
Thank you for the presentation from my team members. I'm going to make some conclusion and recommendation for Company A and B. In summary, Company A is financially stronger than Company B. It shows a good cash flow and efficient collection of receivable. Although it is profitability needs improvement, Company B has high liquidity but suffer from low sales and negative profit. To improve, Company A should focus on reducing costs and increase efficiency to restore its earnings. Meanwhile, Company B must boost revenue, manage inventory wisely, and rebuild inventory trust through transparency and better financial planning. Both companies must implement efficient financial strategy to sustain their performance and growth in the long term. And this is our presentation. Thank you very much.